Good morning, ladies and gentlemen, and welcome to our Fresh Thinking Series 2022. First and foremost, I would like to thank our panelists and participants for making the time to join us in today's webinar. A few years ago, Oraro and Company Advocates launched its flagship event series dubbed Fresh Thinking to keep our clients abreast on current legal trends. Today's webinar is a FinTech webinar on FinTech investments in Eastern Africa. We believe this webinar is very timely given the wave of digital innovation globally and indeed in Africa within the financial services sector, bringing about new products and solutions in the banking industry and amongst non-traditional lenders. I would like to take this opportunity to thank our moderator, Eva Warigia, the Chief Executive Officer of East Africa Venture Capital Association. Eva brings with her a wealth of experience in management consulting, investor relations, and strategic corporate positioning. She is very passionate about private sector value creation, from linking the continent's businesses to financing opportunities. I would also like to thank our panelist, Said, the Vice President, Helios Investment Partners, Juliet Minor, Senior Manager, Regulatory and Public Policy, M-Pesa Africa, and Peter Owaga, Investments Director, Ascent Capital, and of course, our very own Jacob Ochieng. All experienced panelists are industry leaders from diverse sectors and will have an opportunity to introduce themselves very shortly. Just a brief introduction on the law firm of Oraro and Company Advocates. Oraro and Company Advocates is a full-service, market-leading African law firm established in 1977, 45 years ago, by the founding partner, Senior Counsel George Oraro. The firm has a strong focus in dispute resolution and corporate and commercial law. With a dedicated team of several partners, associates, and support staff, the firm and its lawyers have been consistently ranked by leading legal directories such as Chambers Global, IFLR 1000, Legal 500, and others as a top-tier firm in Kenya. We provide specialist legal services, both locally and regionally, in arbitration, asset tracing and recoveries, banking and finance, capital markets, conveyancing and real estate, corporate and commercial law, dispute resolution, employment and labor, FinTech, the department presenting in today's webinar, infrastructure, projects and PPPs, restructuring and insolvency, and tax law. Over the years, we have represented both local and foreign clients, governments, regulators, not-for-profit organizations from target industry sectors, including private equity, retail, construction, education, energy, financial services, manufacturing and industries, and the public sector. We provide both local and cross-jurisdictional legal services, either directly or through the extensive relationships that we have established with leading firms across the globe. Oraro and Company Advocates is a full affiliate of AB and David Africa, a Pan-African business law network committed to ensuring that businesses and projects succeed in Africa by helping clients minimize the risks associated with doing business in the continent. This enables us to offer cross-jurisdictional legal advice in a seamless manner while maintaining the highest professional standards. Oraro and Company Advocates prides itself in its deeply rooted client relationships by offering quality legal services through its partner-led approach, drawing from local knowledge and global perspectives. Ladies and gentlemen, welcome to today's webinar, We look forward to a very interactive session. Eva, kindly proceed.
Thank you so much, Pamela, and good morning to all our panelists and the audience in attendance. I see we have quite the room, over 98 people. Just a few housekeeping rules. Yes, I will be the moderator. If you want to ask a question, you are invited to put your question on the Q&A chat box, the Q&A box rather, of the webinar. It's right down there. Alternatively, you can contribute to the session through the chat platform. But we look forward to having an interactive and fun segment. Like Pamela said, my name is Eva Arigi. I work for the East Africa Venture Capital Association, and we are the umbrella body of all private capital providers in East Africa, largely taking care of the ecosystem by facilitating networking and identification of local opportunities that investors can deploy their investment into. So my role here is to guide the session and the interactions by our very distinguished panelists. And I just want to set a scene on the very dynamic space of fintech across East Africa and much of Africa. We're doing this thankfully on the morning after the FinTech report was launched, so it's fresh with lots of insights. And just for the interest of those who do not or haven't interacted with fintech in the past, it's the platform or the space of tech where tech and financial service provision intersect. And it was largely born, at least I know for Africa, out of the need to connect the unbanked population, which is quite big in our continent. And from those days, for those of us who are in Kenya, we are quite familiar with M-Pesa and trying to plug that role. But since then, the evolution of fintech is forever. Just when you think you've had enough, more of it comes on. And today we have fintech in lending, in payments, cryptocurrency, remittances, just to mention but a few. And I'm sure there's a lot more that our panelists may be familiar with. So digging a bit deeper into the statistics, and just allow me to cannibalize a bit on the FinTech report because it's fresh off the press and you're invited to look at it in details later. Some statistics that I found interesting, just to set the context of why fintech is relevant and why we're having this discussion at the moment as part of Fresh Thinking. Fintech attracted $3.2 billion in 2021 alone for Africa last year. Just the numbers, 3.2 B for one micro sector, because it's part of a bigger sector in the continent that's still very much in the development phase. In terms of volumes, fintech had 219 deals across Africa out of a total of 640 deals in the continent, which made it the #1 investment opportunity for VC and angel and PE investors across the continent. So what's interesting is fintech raised 3.2 B and it was the #1 sector. The #2 sector is logistics at 1.7 B. And that just shows you the magnitude and interest and maybe the scope that fintech has. And I'm sure our panelists will dig deeper into that. So I'm really excited at this session. And to kick us off, we have to start with the macro, and we are in the Orara & Company house. So probably we can invite Jacob to help us set the scene. What's the regulation environment like today, and especially as relates to fintech? How are these numbers being supported and justified even?
All right, thank you very much, Eva. Indeed, this is an area that keep on growing, and we've seen the regulators and the government playing a catch-up role to ensure that any risks associated with this investment is taken into account, as well as coming up with laws that facilitate investment by the investors and also promote entrepreneurs in this sector. So currently in Kenya, we don't have a single specific law that regulates fintech, but a variety of laws that touch on various aspects of fintech. and the various products and services that fintechs offer in this jurisdiction. So just to mention a few, we have the National Payment System Act, which is basically an act that regulates payment service providers. As you had alluded to earlier, most of the fintechs basically facilitate payments from one end to the other, with a view to ensure that the unbanked can be able to access financial services. So most fintechs that operate in this area would be governed by this law and will require a license from the central bank. Obviously, there are some fintechs that play a big role in ensuring that the unbanked have access to financial services, and these are just lending institutions or digital lenders. So recently, last year, Parliament passed a law that brought on board the digital lenders. So this is the Central Bank Amendment Act that now requires digital lenders to be regulated and to be licensed by the central bank. Central bank has rolled out draft regulations which are under review, just to create a framework within which the digital lenders can be able to obtain these licenses, the minimum requirements for compliance, and so on. So we hope that in the next 6 months, all digital lenders will be required to be regulated by the Central Bank of Kenya. The other piece of legislation from a regulatory perspective is the Kenya Information and Communications Act, which was passed sometime in 1998. This act brings on board those fintechs that do not specifically provide payments facilitation or services or lending, but play in that area in terms of providing digital content. So it regulates network operators, content service providers. So if fintechs play a role or are in this sector, then obviously they would require to obtain a license from the Kenya Communications Authority. So these are the principal legislation that would principally govern the regulatory aspects of the fintech business. Now, there are other pieces of legislation that generally apply to all fintechs, because fintechs process a lot of data, and they rely on data for decision-making purposes, for launching their products that are customer-friendly, and so on. So in 2019, there was a Data Protection Act that was passed in Kenya. There are draft regulations that were passed last year to ensure that the Data Protection Act is implemented. So since fintechs process a lot of data, they are required to put in place systems to ensure that the security and integrity of their systems and their systems are not used for purposes of breaching or that ensure that the privacy of individuals who use these services are protected and the integrity of their systems are maintained. So that's a piece of legislation that fintechs need to keep in mind as they roll out their products. The other piece of legislation, obviously, is in terms of security and integrity, is the Computer and Computer Misuse and Cyber Crimes Act, which is basically a piece of legislation to ensure that the confidentiality and integrity of the systems are maintained and prevent the use of fintech systems for purposes of perpetrating crimes. So that's something that fintechs need to keep at the back of their mind. And then there's a process of crime and the Anti-Money Laundering Act, which obviously from an integrity of systems and security perspective ensures that fintechs do not allow their systems to be used for purposes of perpetrating money laundering, crime, and even financing terrorism. So there are pieces of legislation that entrepreneurs, founders, and investors need to keep in mind as they develop and introduce these services into the market. Now, from emerging trends issues, we've seen a number of pieces of legislation and regulations that the various government entities, as well as the government itself, putting in place to ensure they facilitate investment in this sector and encourage investors to invest in this area. Now, the first of that legislation, which is not actually new, but has been there for a while now, are the sandbox regulations by the CMA. The idea is that most of these products are not currently regulated, but there's a need to create a framework within which entrepreneurs can be able to implement these products in a tested environment, upon which, upon successful implementation, they can be rolled out into the market. So this is something that entrepreneurs can take advantage of. The other one is the crowdfunding regulations that have been published by the Capital Markets Authority. Again, the idea is to encourage people who want to pool funds for purposes of financing these startups and fintechs. And it gives fintechs an opportunity to be able to approach these platforms and raise funds through these platforms. Because of lack of proper track records, most of these fintechs cannot be able to access commercial loans from the banks. And therefore, CMA is trying to create a framework within which fintechs can be able to raise money from the public, from both retail investors as well as institutional investors. Once this is implemented, we believe it will create a framework within which states can be able to raise funds. The other piece of legislation that I've mentioned before is data protection. Obviously, this is now big in Africa. In other jurisdictions like in the EU, this has been ongoing. And this is something that we need to keep in mind. Once the regulations have been published, it will create a framework within which fintech can be able to put sufficient systems to ensure they comply with the law. So this is just a summary of the regulations that fintechs need to keep in mind, and these are the initiatives that the government is trying to do in order to encourage investment. Obviously, there's also the startup bill, which was passed by the Senate sometime last year. It's been referred to the National Assembly for debate and thereafter passing. Once it's ascended, we hope that to also encourage the entrepreneurs and founders in the fintech area, because the intention of this bill is to encourage entrepreneurs and startups to create an environment through which they can be able to incubate, test their systems, provide both physical and non-physical support to entrepreneurs in this sector. So we believe this will also create an opportunity through which the fintechpreneurs can be able to test their products and get some form of government support before they are finally launched into the market.
Thank you so much, Jacob, for that very detailed outlook on the regulation space. As one who plays in the private sector, some of us always wonder whether regulation should come before or after innovation. And maybe to help us crystallize what Jacob has provided as the very high level of what's happening in the macro, I can invite Juliet Miner, who's Senior Manager, Regulatory and Policy at one of the most visible fintechs on the continent, M-Pesa, to share a perspective around how regulation is enabling fintech companies and what the opportunities are for even those of us who are on the call and considering getting into the fintech space from the context of policy and regulation. Juliet.
Thank you, Eva, and thank you, Jacob. That was indeed very detailed. I mean, I don't want to replicate too much, but I think what I would touch on specifically is your question around whether regulation should come before or after, and I think it's a question of context. So we are always quick to blame regulation for lagging behind technological developments and not being able to keep up, and so we find innovation is struggling to find a space to operate in. So in some contexts, you'll find, so if you look at the Kenya example, regulations seem to come way after the innovation, and this allowed it to prosper in its market, in its, shall I say, natural habitat, in such a way that the regulator could then easily identify the issues and address that. In some markets, we find regulations is actually a deterrent. So if we look at increasingly people are moving towards the cloud, we're reducing our capital investments on infrastructure so as to leverage certain capabilities that are available on the cloud. And with data protection laws, in as much as some are beneficial in protecting the user, sometimes they go a bit too far in, I would say, limiting the movement of data across borders and preventing that leveraging of capabilities between markets. So in that instance, I would speak to data protection and finding the balance between protecting the user, protecting our privacy, and still being able to boost innovation. And lastly, as Jacob has touched on, I think is sandboxes, which have been, I think are really the future, in that they are really able to support innovators, small companies, to test, drive, to operate their products in a controlled environment, in a way that is protecting the consumer while still allowing them to explore various opportunities. So this not only, of course, reduces their costs when it comes to licensing and operations, but it gives the regulator that confidence, that engagement with the markets to keep up with the trends, to be able to be aware of what's new, what's necessary, and ultimately to meet the consumer's needs. So I think I'll stop there for now, and you can pick it up after. You're on mute, Eva.
I was saying thanks a lot for that. And in terms of providing the scenario where we can use regulation as an enabler, I think most of us default to thinking of it as a deterrent. You've also touched on marine innovation and consumer protection through the sandboxes, which I think is something that a lot of us could explore. Now, on the panel, I have two investors. I have Said and Peter, and both of them are done quite a bit in investing in fintechs, in personal capacity with their institutions. And maybe to start off with Peter, you can provide some framework from where you sit as an investor. How does regulation support your activity in investing or looking at fintech opportunities?
Thanks, Eva. So the way I'd look at regulation in supporting investment opportunities is how clear are the companies in adhering to, let's say, the regulations. Because, for instance, at the moment we have, consumer protection where the data for consumers is being protected. So if an opportunity comes my way and they have not adhered to that, then it becomes quite difficult for me to even look at it, because then they are contravening the law. Now, when it comes to how easy is it to even navigate certain regulations, that becomes, again, a much more difficult conversation with a potential opportunity, because you find there are some opportunities which are very attractive, for instance, especially in the lending space. And just given how the level of regulation that is coming into that space, you then are a bit hesitant to look at certain opportunities, because you might find that an opportunity is quite profitable, but this is because they are charging their customers a very exorbitant rate. And you know for sure that eventually the regulator is going to catch up with that, and it's just a matter of time. And so at that point, you then have to think about your risk versus your return, because how quickly can you get your return, but at the same time, how easy is it for that return to disappear in the next, let's say, 12 to 18 months. So then you build in your buffer. Now, at the same time, you might decide, okay, they might not be playing in the lending space, or they might be playing in the payment space. Now, there again becomes a bit murky, because with payment, you are gaining a lot more information on consumers. And again, that is information that you have to keep separate from, let's say, people accessing it and using it or misusing it, which is where now the Central Bank of Kenya, at least, came up with regulation around misusing data for consumers. So it's something that has become a bit more top of mind, I would say, for investors, at least on a personal capacity, as well as for institution, where we are very keen to determine how adherentities to success. And so that's where now people like Oraro and company communities. So they do assist us in the due diligence phase, where we are looking at, okay, what are the things that either they're doing wrong, or what are the things that will need to be done once we invest. So again, it also informs how much you're going to invest insofar as getting up to scratch, and then what do you need to do to ensure that you do not go into any clashes with the regulator. So that's how I would look at it.
Thanks, Peter, and apologies for my excitement, everyone. I forgot to introduce Peter as one of our investor panelists. Peter is Peter Owaga, Investment Director at Ascent Capital. He's a venture capitalist with 8 years experience in seed investing, doing it both at an institutional level as well as a personal level. He's invested in 5 startups using a mix of equity and debt, and he'll talk about that, of which he's realized 3 exits. So truly exciting in terms of also talking about money back. And prior to working with Ascent, Peter was also part of the Centum group. So that was Peter who was speaking, and the other investor on the call is Said. And Said is, sorry, I lost your intro. Not to discount it, but yeah, I think I got, yeah. So Said is a vice president at Helios Investment Partners, which is a PE fund with a Pan-African footprint, where he has been focusing on growth and private equity investments for 6+ years. And he's also an avid participant in the Africa FinTech ecosystem. Before working with Helios, Said was at Credit Suisse within the consumer and retail investment banking division based out of London. So we've heard from Peter, and he's talked about his considerations on how regulation affects their fintech opportunities. Said, from where you sit, I know you've done a bit of high-profile towers, big fintech solutions or integrating platforms. Maybe you can also mention, how did regulation impact those investments, and were there some learnings around how to deploy capital into fintechs that you could share with this panel?
Yeah, I think as a firm, we've been very successful with investing in the fintech sector in the past, having backed, I think, 2 of Africa's first unicorns. One being Fowry in Egypt, and another one being InterSwitch in Nigeria. And then Kenya specifically, I don't know if you call Equity Bank a fintech, but we helped the management team there roll out their agency banking business, which ultimately led to Equity Bank becoming the largest bank by customers in the country. And I'd say that was a kind of early innovation in fintech after the whole M-Pesa innovation that kind of substantially changed the industry here. I think, investors care about 2 things, right? Investors care about risk and reward. And I'd say regulation touches on both of those. Some of my esteemed panelists over here have talked about some of the regulation around kind of sandboxes, for example. And then I'd say that from a reward perspective, particularly from an early stage, when businesses are first launching services, etc., these sandboxes can actually give consumers a lot of comfort around the products, given there have been kind of numerous scandals in the past, and people have escaped the purview of the regulator, kind of showing consumers and the wider public that you are kind of that the regulator has their arms around you and that you're kind of walking hand in hand. It gives consumers a lot of comfort in kind of using your services. One specific example being one of our portfolio companies, Acorn, which is a student housing provider, launched its REITs. And Acorn wanted to provide some of these very high grade institutional investment opportunities to more retail investors. And although Acorn has a kind of very good name amongst the institutional investor community in Kenya, from a retail perspective, it was slightly different. And what really helped us was being able to go into the CMA sandbox and really testing those products, working with the regulator, and giving consumers the comfort that this was a legitimate product with the right backing from institutional players that are not gonna run away. So from a reward perspective, I'd say regulators and regulation can actually play a very important role in the early stages of an industry from a kind of catalyzation perspective. From the risk perspective, I think Peter and the rest of the team have talked about that, but obviously it's 2 things, but the key thing on regulation is clarity, right? Understanding what regime you operate under, and having the comfort that that isn't going to change overnight. And should it change, that kind of adequate public participation will take place before kind of, those changes are made. And I'd say, from a Pan-African perspective, looking at Kenya specifically, I'd say, we have some of the smartest, most well-educated, most professional regulators on the continent. And the key thing there is, I believe kind of fintechs need to work more closely with the regulators in order to manage regulatory risk. Regulators want to understand that, they are dealing with legitimate counterparties. They don't want to find out from newspaper articles and ads on Facebook and Instagram that there are kind of providers out there. They would like providers to walk in through the front door and basically work hand in hand with them to deliver whatever services that they need. And I'd encourage kind of fintechs to adopt that approach in basically rolling out their services. And again, because of the pace of fintech adoption and the kind of transformational impact that fintech can have from a financial inclusion perspective, regulators understand that regulators want to help, but at the same time, they obviously have a trust deficit, and they should, and it's really up to businesses to kind of close that gap and make them feel like they're kind of good partners to the wider public. So I'd say that's kind of how it affects us. The clarity kind of item is quite important, but I'd say from an investor perspective, just given how quickly fintechs adopt new products and services, you can have clarity on month 1, but on month 6, you'll be in the same position of uncertainty because they will launch 3 other products. And these 3 other products are the new hit thing, and they all are under some form of kind of, regulation. So you're always going to have that uncertainty. So that's kind of how I'd approach it. You can't really have like, full regulatory certainty till the end. What you need to understand is, how amenable is the regulator to working with the wider public and with other businesses. And in Kenya specifically, I mean, we've been blessed with pretty professional regulators. And one of the interesting things that is happening, I mean, given the success of the sandboxes with the CMA, and then following that with the Insurance Regulatory Authority, I think InsurTech is one of the key sectors within FinTech. And there's some very exciting businesses that have come out of East Africa, Lami being one of them. Given the success of these, regulatory sandboxes, there are a lot of institutions like the Financial Sector Deepening Authority that is working together with other African governments to implement sandboxes like the type that have been successful in Kenya across other jurisdictions. And I think that would be really helpful from an investor perspective. Yeah.
Thank you so much for that very comprehensive perspective, Said. It was interesting to note that a big project like Econ can also go into the sandbox. I think for us, we default sandbox to thinking startups or idea prototyping. So it's really, refreshing to know that our regulators are that accommodative, and you're right in pointing to the IRA, at least for the local audience, the Insurance Regulatory Authority of Kenya, the Capital Markets Authority of Kenya, some of the very proactive regulators we have in this space, willing to support market development alongside with their function of regulatory oversight. You concluded on a very interesting note, Said, which talked about the clarity and how important it is to you as investors, especially because fintechs evolve quite rapidly. And as we get into the discussion around investing into fintechs, I wanted to bring Juliet Maina into the conversation, just to piggyback on what you've started. At what point should we engage the lawyers like Oraro and policy and regulatory experts like yourself as fintech owners or investors when you're considering going mainstream? Is it after we've prototyped the product, gone to market, or before?
Thanks, Eva. And I think the Oraro team will like this, but in my opinion, it's always to bring in legal and regulatory as early as possible. to be able to understand the risks that are arising from the product before too much investment has gone into the creation of the product, even in the course of kind of market study and being able to understand what's out there, what's comparative in different markets. I think the earlier we're able to address those risks, it's always the better. And I think from a regulatory perspective, if we are able to gain audience with the central bank and bring them into the know of what's going on and what you're developing, assess that based on their risk appetite and how to then provide assurances against those risks. I think, again, the earlier they do it, the better. The last thing you would want is to have been at the end of your product and then you engage a legal team or a regulatory expert and they tell you that this is a no-go in this market, simply because it was successful in another market. So it's important to really be able to take each market on a case-by-case, engage accordingly and as early as possible, and address these risks as early as possible.
And Jacob, we will default to coming to you a lot of the time for these issues. But again, as investors, one of our concerns is you're bringing to the spotlight of the regulator something that even you are trying out. So what are some of the remedies that Oraren company and teams like yourselves can help the investor in walking through? Maybe you can give us a few items that would be key to make sure we ring fence and protect and check off with the regulator. What are some of the permits we need to get, if any, licenses? And I know they're not exhaustive, but you can help us with that very top line.
Thank you, Eva. As has been alluded to by my colleagues, it's quite important because of the differing and the ever-evolving technologies and products from FinTech sector. It's always important at the beginning to determine whether you fall within any regulatory ambit. As I mentioned before, it's either you are a content service provider falling within the Communications Authority of Kenya regime or the central bank regime because you are a PSP, or within the digital lending sector because you are lending. So at that very early stage of developing that product, it's quite important. And from our experience, the fintechs that we have assisted, we have always worked with them the journey. In fact, in some cases, we realize that there's a thin line between whether your product falls within this regulation or the other regulation. So if you involve the lawyers early in advance and the regulators, then at the point of now applying for that the particular license, at least they are aware of your product. So I would agree with Juliet that at the very beginning of the development of that product is always recommended to engage with the advisors as well as the regulators so that you are sure that you are on the right path. The other item, other than the regulation, is obviously FinTech. The major asset, the main asset of FinTech is actually the IP. And in most cases, it's very difficult to determine where that IP sits because an entrepreneur comes up with an idea, engages a few developers, develop a product to implement that idea, and it's not quite clear whether who owns the IP rights to that product. So then at the point of getting an investor will ask you that question and it's not quite clear. So it's very important at the initial stage to ensure that you determine where that IP should sit, and necessary arrangements, including non-disclosure agreements, patent or transfer agreements are put in place to ensure that that IP sits within the entity that actually is providing that service. So those key issues, regulatory IP and other customer and consumer protection issues need to be thought through, and we are happy to assist fintechs, and we have assisted many fintechs in this area to ensure that they start off on a good footing. Thank you.
Thank you, Jacob. And there's already a question in the question box. Doesn't inviting the regulator or the legal firm stifle speed of innovation? Uber wouldn't have been a success if they had sought permission from the local transport authorities. Something we can reflect on, but yeah, it's always a delicate balance.
Quick learning. So in the US, there were two businesses in the consumer lending space. One was called Lending Club, the other one was called Prosper. Prosper is no longer kind of around, they got shut down. Lending Club existed because specifically in FinTech, you can't move fast and break things. You're playing with people's money. It's extremely important. You cannot move fast and break things. And if you do, you'll get shut down. And let's be very kind to our regulators here. They're well within the right to do that. And they've seen examples in other jurisdictions like the US. So FinTech is not FMCG distribution. It's not ride hailing. It's people's money. It's serious. And you cannot do that.
Great insights, Said. I want to pack the regulatory discussion, and I'm happy to come back to it during our Q&A segment at the end of this. Just a reminder for those who joined us, you're welcome to put in your questions through the question and answer chat box or through the chat platform of the webinar, which is provided by the Zoom portal. So the segment I would like to go into is my favorite, investing in FinTech. And as I started by saying, at least from the latest data shared by Patek yesterday, FinTech raised cumulatively $3.2 billion across Africa out of 219 deals executed. For this market, we have quite a number that raised last year, Tala, Wapipe, Pezesha, just to mention but a few. And at this point, maybe get insights from Peter and say, there's a big buzz around FinTech. What is it that's driving investor interest in FinTech at the moment? What are you looking at? And we can start with Peter, then say.
Thanks, Eva. So the key driver towards FinTech companies at the moment is purely because it's the easiest place to innovate. It doesn't really, so it's not your traditional manufacturing business where to actually innovate, you have to invest quite a bit on capital expenditure. Whereas in financial technology, again, it's just technology. Now, of course, the flip side is that these are working assets. So your developers are your key, I would say, revenue drivers, yet at the same time, your key risk aspects. So as well as the fact that we are in an interesting place or space in Africa where the internet penetration keeps growing. And so as interactivity keeps growing, you're able to layer on a lot more to it. And the quickest way to do that, again, is through mobile phones. That's why you're finding either payment technology or even smart funding is gaining a lot more prominence in the investment space. And it's, again, one of the quickest ways to determine value, because it's about how much are you actually making insofar as your company is concerned. So you can't, it's not one of those where you have to go and count inventory, where you have to look at receivables, payables. No, it's a lot more straightforward than your traditional investment opportunities. So that's where the interest is coming in. Now, of course, with this interest, there's, again, the flip side of valuation. So valuation will keep going higher and higher as more and more players want to get into that market. And that's where now you're finding a lot more angel investors and VCs will be squeezed out by the larger funds, or there'll be, let me not say a lot of losers, people will be left holding the baby with the bathwater.
Thank you, Peter. And valuation is a whole other subject that Aurora should invite us on for, because that's a Pandora's box in and of itself. Said, what are some of the trends that are driving even Helios's own investment in FinTech? And also, if I can just combine two questions, how do you see the transition from the days of industry, which are hardcore assets, so to speak, into modern day FinTech, which are remittance-based, crypto-based? Is there a trend to a certain kind of FinTech future?
I think, I mean, the interesting thing is that, so the FinTech opportunity set and total addressable market increases every year in Africa. And that's because successive cohorts of new fintechs build on infrastructure and regulation and so on and platforms, etc., that previous fintechs have developed. In 2000 to 2005 in Africa, our financial landscape was dominated by legacy banks. In about 2006, 2007, we started seeing M-Pesa being kind of one of the largest innovations copied across the world. And some of the agency kind of banking type innovations start. What that allowed us to do was turn physical cash into digital cash. Once it was possible to turn physical cash into digital cash easily, and it was accessible to many people, then then payments companies became a thing. If there was lots of digital currency that could be moved around, payments companies were more viable, and payments companies took off, and remittance companies, many of them took off. After payments companies built the rails that allowed businesses to pay each other and consumers to pay businesses and so on and so forth, then other use cases started. Then you saw the rise of lending businesses like Tala, like Branch, like others, right? And most recently, kind of, Fuliza, M-Shwari, KCB, M-Pesa. So every successive cohort builds on the legacy of the previous cohorts. Now, when you have companies that are doing lending, at some point you need life insurance, because if you provide a loan to someone over a long term, you need life insurance. And now, are you going to go to a typical insurance company with a manual process when you are a lending company that is churning out 10,000 loans a day? It doesn't work. So you go to an insurtech. So suddenly, over many years, there are a proliferation of new opportunities available in the financial technology space. Companies like InterSwitch, etc., have grown with that over time, have constantly innovated over time, and innovated very quickly in order to maintain that status. But I think the very interesting thing right now, from a kind of investment perspective, is just how many different types of fintechs are kind of proliferating, right? So in today's age, you're getting a lot more specialization. You're getting a lot more providers of services to other fintechs. 10 years ago, if you had one fintech, you couldn't start a business that was supplying services to fintech. You'd have one customer. It would be Safaricom. Today, you can start a business that does B2B, infrastructure providers. You can provide credit scores to people as a service. You can provide consumer profiling. You can do digital KYC. There are so many businesses today that are viable that could not exist 5 years ago. So I think that proliferation of the opportunity set in fintech is extremely exciting, and I think it advantages investors who are based on the ground, that see the opportunities firsthand, and can really kind of take advantage of those smaller opportunities before they blow up.
Thank you, Said, especially about highlighting the growth of fintech relative to the disruption in the market and expanded consumer base from probably relying on telcos as our final consumers. We now have direct fintech, sort of a B2C approach even for fintechs. And this leads me to the question of, when you're investing in fintechs, especially those that are founder-led, maybe not so old, mature businesses, what are you looking at? And if you can just narrow down to the East Africa market, what are some of the things that would make you look twice at a pitch deck, a fintech pitch deck? Peter, you can go first. Give Said a break.
All right. Thanks, Eva. So the first I would say I look at is whether this is a copycat of another product. And then secondly, is the founder trying to create a problem for the solution? Because at times that tends to happen with a lot of startups, where you feel that this is a problem that a lot of people have, but at the same time, that might not be true. It's just a solution without necessarily a problem, which again tends to be a bit difficult to determine. Then look at what we are referring to as the use case, right? So yes, you have a solution, and yes, there's a problem, but how easy is it for your user to use this particular solution? It might be that you have created a solution that is going to be the next sliced bread, but if someone is unable to use it, then it will remain sliced bread in a jar that someone cannot be able to access. And that's where now I think Said touched a bit on, where people keep building onto the tracks that previous people have used or people have built. And so if a founder comes to me and tells me, okay, this is my solution, this is the problem that it solves, the next thing I would ask is, okay, how many, have you actually had a trial run for this product of yours? How many people have used it? What's the churn rate been like? What's the feedback that you've gotten from people? And then what iteration is this product? You might find it's the first iteration of the product, which at times is not usually the best, because you'll end up having to do a lot more as people use the product more and more. So you'll find you're pivoting from, let's say, lending to payment to probably crowdfunding to probably now becoming an entire platform. So the iteration again allows me to be able to tell at what stage are you in the continuum of a financial technology company. So that's how look at the business. And then another key thing that I think most founders tend to frown upon is experience. Because yes, you might be the best developer, but what have you developed before, right? It tells me how good of a developer you are, just being able to see what products you've actually done before. Because then it tells me, one, you have the skills, and then two, you have the actual experience to build upon something that you've done previously. So that's how I would look at it when a founder comes to me with a solution.
Good insights, Peter, and you've touched on something really relevant and critical, the founding teams. I spoke to an investor one time and they shared some of the successes of other markets in Africa is the ability to get people who had brand name experience being startup founders. The fact that you can confidently say I'm X, this company that's listed elsewhere, somehow gives investors confidence. But Said, do you have something else to add on to that? And especially because you're a unicorn builder yourself, how do we get unicorns into East Africa?
So hopefully one day I'll be a unicorn builder. But Peter, I think, touched on some of the key things. I mean, it's really, if you break it down, it's kind of three things you look at. You look at the total addressable market, you look at the team, and then you look at the unit economics. If you're at a late enough stage where the business has kind of, credible numbers on unit economics that you can have a look at. If you're before that stage, before kind of Series B, etc., then you kind of need to understand, okay, I might not be able to see the numbers on the unit economics now, but as Peter said, let me really understand the problem that they are providing a solution to, and really dig and understand, is someone willing to pay for a solution to that problem? And normally people are willing to pay for solutions to problems when those problems are large. So is it a large problem that they're solving? And therefore, will someone pay them to solve that problem? After the businesses become larger, it tends to get easier. You look at the team. I think localization is a very important thing that has been overlooked in the past, particularly in our tech ecosystem here in Kenya. A strong localization of founding teams just makes businesses better able to manage risk and generate commercial opportunities in Africa. It helps if you're African. I think the second thing is the kind of total addressable market size. It's easier to understand, how businesses will progress, et cetera, et cetera. So yeah, I think it gets in the early stages, it is quite difficult. It is very difficult. You have limited information. So you really need to understand the sector in depth. Yeah.
And bringing Jacob as one of the facilitators of these partnerships, how do you ensure that the terms are aligned? The entrepreneur will be very keen to maintain a certain shareholder level. The investor will come with terms around operations and governance. How do you ensure that this partnership lasts for its intended reason? And maybe you can give us tips as advisors to the entrepreneurs, to the investors and builders of the fintech ecosystem on some of the key considerations from an agreement perspective.
All right, I think it's very important at the inception, actually at the time of onboarding investors to agree on what the interests are and whether the interests are aligned. Because most cases, if you find an investor whose interest is not aligned with the interest of the founder, then however much better the agreement is drafted, obviously at some point the relationship will not work. So therefore, it's important at the inception just to ensure that the interests are aligned. And in the event that the interests are not aligned, what are the mitigating factors that you need to put in place to ensure that those interests can cooperate or can work together? Because you find in some cases investors are here for a long time. Sometimes the investors are just here for a short time, get reward, and then move on. So then it's very important for the founders to understand what's the full term for investment and what mechanisms do I need to put in place to ensure that that those are taken into account. Obviously, from a contracting perspective, once those interests are aligned, we can be able to incorporate that into the agreement and ensure that at the time of exit, you can only get better instead of when an investor exits because perhaps he was playing a very strategic role in steering strategy of the company, ensuring that there's good corporate governance. Then obviously at that point of exit, then the company might struggle a little bit. But if we have those strong corporate governance procedures well drafted into the agreement, then in the long term, when the investor exits, then you can only grow better at that point. So it's very, very important at that point to ensure that those contracting arrangements are in put place, the interests are known and well documented, and so that at exit the company does not suffer or there are no disagreements in the course of the relationship.
Okay, and piggybacking on that, still the microphone with you, Jacob, is some of the agreements that have been coming up, a lot of them borrow from the West, Silicon Valley being home of tech and venture funding. How do we ensure that they are aligned to the entrepreneur interest? I speak to say safes, for instance, and you can get into what safes are. They seem to be very focused on protecting the investor's position. How do you ensure that the entrepreneur stays hard? And what is the counter to a safe, where your investor brings a safe to the table?
All right, it is important for the entrepreneurs really to understand the nature of the legal arrangement that they're entering into, because at most times when the entrepreneur is actually most vulnerable, looking for finance, there are chances that he's likely to sign on the dot and move on, just looking at the money, but not looking at the dots or looking at the finer details of the details. So then at that point, it's very important for the entrepreneurs to get a lawyer on board who can be able to assist, interpret those issues so that there's no disagreement at the time of exit or at the time of conversion. So most instruments that we've seen in this jurisdiction, especially at the initial stages, are convertible loan notes. Because at that point, the business perhaps is at the development stage. There's no surety that the product will actually be viable in the market, and therefore the the investor wants to be protected. So they enter into a convertible loan agreement. So should those parameters be met, then obviously it's converted into equity and the investor becomes a shareholder in the company. We have seen other instruments like straight loan, where the investor is not actually interested in the business, but just want to get a loan, which matures after a certain period of time, and he gets back his money. But in most cases that you mentioned, where at the initial stages, the still investor doesn't want to get into it, doesn't want to be involved in the business, but he likes the idea and wants to get on board at some point of time. And this we've seen mostly with US investors, so safe notes, which are basically standard documents that sets out the future valuation of the parties. Basically, safe notes are instruments that the founders and the investors sign with the intention that at some point in time, when a particular event happens, then they can be able to convert that instrument into equity and they become partners in the business. So it's a straight equity instrument. The most important thing, discussion that the founders need to keep in mind is evaluation. Agree on the valuation methodology, so that at that point, that event, it could be equity financing, it could be something that they have agreed that will happen. At that point, we need to agree what will be the valuation at that point for purposes of conversion of that note into equity. So once that has been done, then it makes it easier for them to be able to convert those instruments equity at that particular point in time. So we would encourage the entrepreneurs in the room to ensure that they get sufficient legal advice on those instruments before they get into them, so that at least they understand the nature of the legal arrangement they're getting into. Obviously, at an advanced stage of investment, where we're having Series A, Series B, or other forms of financing, at that point, obviously, the product has been tested, it has potential for viability, and therefore the investor would want to be in the business for the long term. So then the instrument they enter into is either a share purchase agreement, where they purchase some shares from the founders, or a subscription where they issue new shares in the business, and they want to get into a shareholders agreement that will determine that relationship, so that at the inception, they already know how they're going to govern the company together, because they're now joint partners in the business. So those agreements, it's very important to have the lawyer on the table, so that you are fully appraised of what your legal obligations as well as rights are in relation to the contracting arrangement.
Thank you so much, Jacob. Now moving into, so we've gone through the macros, the investment, pre-investment process, and now we're into the investment itself. And we've looked at, now people have agreed, they're now doing business together. One thing about tech companies is they will evolve, and with the evolution is a call for more money. So multiple round fundraising. And again, I hope the investors can talk to that. Just to set a context, again, drawing from the FinTech report, in 2021, out of 640 deals, there were 681 rounds of fundraising. So beyond Series A, B, I don't know what level we get to in the alphabet these days, but in total, 640 deals were done in 681 rounds. Maybe someone did 2 rounds in 1 year. Bringing Peter into this conversation, I want to understand at what point do you know you're ready to go into the next stage? And as an entrepreneur on this call, when should I start preparing for the next round? Is it when my runway or money is almost running out? Or should I do it the moment I raise round 1 and I'm coming back for round 2?
Thanks, Eva. So I would say capital to a startup is like water. They can either sink or drown at times. So if you give them too much capital, then you end up with founders who drive very large cars and decide now they want private jets. And then if you give them too little capital, you end up in a situation where the business is barely surviving, barely clinging on to dear life. So it's, again, a very fine balance between how much capital is actually required. And so if, for instance, it's at the idea phase, then you would expect that the next round of funding would be at the ramp-up phase, where they already have a minimum viable product. They've proven the concept. They've shown that, yes, we can actually get users. And now we require a lot more capital to ramp up our users and possibly to increase the capacity of this particular product. Because a minimum viable product is exactly that. You don't expect it to have too many features. You don't expect it to be the ultimate goal. You want at least to, again, have a lot more iterations as time passes by. So I would expect by the time they want now to ramp up, they would be seeking capital. At that point, it becomes a decision point for the investor, right? Where I'm thinking, okay, is this an entity that I actually do want to back? And what has happened from the idea phase all the way to now the MVP phase? If at that point, I'm noticing a trend where developers are coming in and out like a revolving door, no matter how good that product is, then chances are at some point they're going to get into trouble with a developer. A developer is going to come back and say, oh, this is my intellectual property, or I built this particular aspect that was very unique to me. So please, can I get it back? So that again is a bit of a worry. Now, once they've moved from, let's say, the ramp up phase to proper scale, where now they want to go beyond, at times, go beyond the local borders, again, they go for further round of funding. Now, here is where it becomes slightly tricky, because at that point, they might be too large for either a VC fund alone or an angel investor alone. At the same time, they can also be too large for multiple VC funds, because you do not want your capitalization table to have, let's say, 10 investors. At that point, a decision won't be made very easily. But again, depends on how you've contracted your agreements. So you come in with a private equity fund, who then takes it to a much higher level, because now they're looking, instead of it just being in one location, let it be something that is either Pan-African or even at times global. So that's how I would look at multiple rounds of funding. And the smart founders tend to anticipate this before they actually need it. So a smart founder will be able to tell you, by the way, in a year, I'm going to need X amount. Do you think you'll be able to provide this funding, or do I need to go for other people to provide this funding? So that's the kind of smart founder that you would want. At the same time, you also want an investor who is able to see, who's been able to go to a lot of startups, and they know that at this point you will require X amount. So it's a delicate balance between the founder and the investor, where you have multiple conversations around what are the needs of this capital is actually adequate, and have we created a buffer? Not too much, not too little.
Great, thanks, Peter. I want to bring in a question from Lewis Muguro, and Said can help me answer this because it also speaks to the multiple rounds. Recently, LPs consisting DFIs, HNI, or high net worth individuals, family offices have taken active lead in direct investments in fintech. Does this cannibalize on the opportunities within your reach? You're, I suspect, being investment institution, since the same LPs have lower IRR demands. And the reason I bring in Said is because I hope we can talk about the different players at the different rounds. I know it's unlikely Helios will be in pre-seed. So is there room for all of you to coexist?
Yeah, I think what you ultimately want is a fundraising environment where you have a lot of different providers of capital. If you have many different providers of capital and entrepreneurs have a choice, they can pick and choose what is more productive for them at a different stage of their business. If you're just starting off your business and you're pre-seed, you're better off having a high net worth individual that is interested in your business and has the ability to materially drive your commercial opportunities and reduce your overall operating risk. If you're a Series C company, and you need $100 million of capital, unfortunately, you have to go to an institutional provider of capital that can provide that capital at scale, and then provide a bunch of ancillary human capital to assist you in your development at that stage. So I think a good choice of different kind of providers of capital is good for entrepreneurs. Institutional capital should face competition, particularly at the early stages. It should face competition. And really, in the end, it's better for the entrepreneurs. The entrepreneurs need to have capital, not just for the sake of the cash, but for strategic advice, for business development support. Actually, what they really want is they want partners when they sell equity. And at each individual stage, you need a different kind of partner to take you to the next stage and the next round of your development, right? If you're a pre-seed, you may need 3 contracts to get to a seed, right? And if you're a 5% angel investor can provide 3 contracts, that's all you need. And at that point, if you're competing against a micro VC who's just providing capital, I mean, it's natural for the entrepreneur to want to go with an investor that kind of, as a partner, solves the specific problems that they're dealing with at that stage of their development. Over time, I don't know if that answers the question, Eva.
It does. What I'm hearing is there's room for everyone depending on the different rounds. There's room for the HNWIs, there's room for the institutions. I don't know what your take is on the returns and whether you're still able to realize the returns you want, given the competition of capital. Yeah,
so I think, in Africa, there are ebbs and flows of capital, just like in every other jurisdiction, but they've been quite extreme here over the last kind of 15 years. You have cycles. You have cycles when there's more money and there's less money. And you, as a founder, as an investor, you need to put your head down and you need to focus on the real value that's being created. And you need to make sure that you are a good partner to your businesses. You can provide value creation support, whether it's finding human talent, whether it's finding additional debt or equity capital, whether it's creating commercial opportunities. You need to be focused in the reality of what the businesses need to scale. And you kind of need to, yes, will you miss good investment opportunities when markets are hot because of valuations? Definitely. Because at some point you don't want to participate. But over time, if you keep your head down, if you focus on value creation and being a good partner to businesses, you will make money.
Got it. I am
sorry.
Yeah.
If I could jump in there slightly, because Said has touched on something quite interesting about competition. And I think, there is healthy competition, and then there is competition that is destructive, right? So if we look at DFIs, for instance, yes, they do provide healthy competition, but again, founders need to be, just the same way Saida said, they need to be careful about who they pick as partners, right? Because DFIs tend to have a different outlook insofar as investments are concerned. So you might find for DFIs, their focus is not necessarily return, but more towards the softer aspects of investment. So you'd look at your ESG, which is environment, social, and governance, as well as impact. So your financial technology companies at times have been accused of not having impact, just focusing on return. And this is, the lenders who give a bad rep for financial technology companies. But so long as competition is healthy, then it's good. We do not want a situation where there are too many funders who then drive up valuations to levels that are unsustainable, which is, I think, what happened some time back in a sector that shall not be mentioned and in a fund that shall not be mentioned.
Okay. And I want to close this bit by asking, is there room to blend all this capital into a single round? Can we blend the DFIs and the angels together? Can we blend even the forms of capital? Not everyone wants equity at the moment. Is there room to do equity and debt or a convertible within the same round? And then we can, yeah, let's just hear your thoughts on that.
Peter, do you want to go first?
All right. So yes, indeed, there is room to do kind of blended financing. And this is where I would say I give a lot of credit to DFIs because they're really good at soft debt, right? And that at times is what a startup really needs. They don't want to give up equity. They just need financing to move from one stage to the next. So this helps at least founders who are averse to giving up equity because they feel that they're so small at the moment. All they just need is to move to the next stage where now the valuation will be much larger. Therefore, a larger round of funding will give the investors smaller equity. At the same time, if you look at some of these financial technology companies, the blended finance works best for them because there are aspects of the debt or quasi-debt that will assist in particular instances. So if you look at smart funding, for instance, the soft debt assists them because the cost of that debt is lower than what they're going to get from the eventual consumer. So they get the soft debt from DFIs, but then they get institutional capital from now traditional private equity investors or angel investors who understand the market. So you'd find, for instance, traditional private equity investors are much larger than angel investors. So they have a lot more, I would say, contacts and context, because you would find they've invested in markets like Southeast Asia, where there are things that have worked very well. So they know what needs to be put into this particular company to work, or what needs to be put into this product to work. Whereas the angel investor, what they offer is the contacts, the local contacts. They understand the local market to the level where they are able to engage, let's say, regulators, if the innovation is going faster than regulation. So that's how I would look at blended finance.
Said, you had something to say? Maybe you can.
Yeah, I think with funding, I think it's two things. One is you want to keep it as simple as possible, because in general, the entrepreneurs that are building these businesses are not necessarily people who have 30 years of experience in investment management and can understand all of these instruments. And when you cannot understand something, there's uncertainty, there's anxiety, and there's a host of other issues that can come up. So I'd say the key thing is simplicity. And I think that the second key thing is, what are you using the capital for? And that's where you really, when you're raising capital, you need to be super focused. What are you using the capital for? If you have a clear indication of what you're using the capital for, you can ensure that you are raising that capital in a way that is most beneficial to you. If you're a fintech that is on lending capital, don't raise equity, right, which will dilute your cap table. Raise debt, and preferably even off balance sheet, right, that you can just on lend but will not cost you as much. If you are raising money to create social impact in the world, have a blended finance instrument, right, where your cost of borrowing ratchets up or down based on whether you're delivering based on kind of SDGs. So it depends, what are you using the capital for? If you can tie the raise to the use of the capital, it gives investors more comfort. You ultimately get a better deal, and it's just simple. So I'd say those kind of two things are what I would bear in mind. Keep it simple, and try your best to make sure that whatever form of capital you raised is based on kind of what is optimal for what you're using it for.
All right, thank you very much. Said, I don't know whether Juliet, you had a comment on blended finance, maybe from your perspective.
Not at this time.
All right, excellent. I think the other question that Eva seems to have dropped, the other question that we are addressing is in terms of, by the implementation of the African continental trade area, whether it creates opportunities both for the investors and for the entrepreneurs as well. So perhaps Juliet can just give us your perspective of how the African continental trade area is likely to boost trade and give incentives both to the investors as well as the entrepreneurs and any other trade blocks in this jurisdiction.
Thanks. I think from a FinTech perspective, I think what you would expect from the coming together of the continental opening up and the attempt to remove blockers is something that's already in play a little bit in terms of opening up the payments systems and the payments across borders in Africa. So this, being quite early on, it will be interesting to see how that will remove certain blockers. Currently, it is mostly focused in the West Africa region. The hope is that this will spread out into the rest of Africa and really make transactions across the continent very seamless, allow for investment to make sense in a scalable manner. And as the agreement is just newly enforced, I think we're looking forward to seeing the implementation and how that will boost innovation and collaboration across borders.
Thank you, Juliet. Perhaps from the investors in the room, do you think that by fully implementing this, FCTA is likely to reduce the cost of capital, because we expect that by movement of people across borders is likely to increase the inflow of capital as well as creating opportunity and markets for entrepreneurs as well. Perhaps you can get your perspective, Peter.
So I would say the greatest impact it would have is on the investee companies, because then it allows them to be truly Pan-African, right? Rather than being localized. And so where it allows them to enter markets much more easily, then that is a benefit, a clear benefit. From a fund perspective, not that much of an impact, given that these funds tend to be already cross-border rather than just localized. And with funds, we are allowed to invest in various countries. Now, if it allows for a unified, I would say, competition regime, then the better. Because what we've noticed is we have to always keep going to various competition authorities within various markets, especially if you're investing in an opportunity that is cross-border. So if it allows for a unified competition regime, then it makes investing in this type of investments that much easier. So that's how I would look at it.
All right, thank you. Welcome back, Eva. We are just giving our perspectives on whether the African continental trade area is likely to create opportunities both for the entrepreneurs as well as the investors. So Juliet has given her perspective, Peter, so perhaps Said can give his perspective as well on this, and then I'll hand over to you back to you.
I think we're all hopeful that the continental free trade area will create more trade amongst African countries. I think it solves one of many bottlenecks, though, that basically come into kind of trade from one African country to another. And the reality is that fintechs have been taking advantage of these bottlenecks to a very great extent. One of the largest, businesses in the fintech space, one of our unicorns in Africa, Flutterwave, one of the primary problems that they looked to solve in the beginning was cross-border payments within Africa, because they realized there was so much friction with that. And there are many, kind of frictions that kind of people face when trading across borders. So I think this will hopefully solve one of those frictions, which is tariff barriers and other non-tariff barriers to trade. But there's still a bunch of stuff. There's still logistics, there's still payments, there's still communication. There's still a lot of stuff that needs to be solved, and therefore opportunity for financial technology and other technology-enabled businesses. But we're hopeful. Yeah.
Thanks a lot, Jacob, for holding the fort. Apologies, everyone. Someone should invent an NFT for power blackouts. So, but anyway, it's interesting perspective shared on AFCTA. I think from where I see it, what I'm most looking forward to, and maybe someone may have mentioned this, is flattening of the regulations so that we don't have to deal with multiple regulators across the different borders. Said earlier mentioned that one of the requirements of a fintech to scale is the total addressable market, and I think the FCTA provides a very good total addressable market if all those regulatory barriers can be reduced. I see a rather interesting note from Nawal. I hope I said that right. Nawal mentions that investors may need protection of Africa Union by introducing some sort of convention against disruption of internet services by the regulator or military governments. And I think she's has a country that she's operating in, Sudan, where telcos are incurring losses out of state interference. We've seen it in the past around elections, and I think these are also some of the teething tools that problems that come with working in Africa. And hopefully the AFCTA provides that protection against the losses incurred by business owners from such interventions. I don't know if someone wants to comment on that. All right, but now we do take in your note and appreciate it. There was also a question that Lewis had posted earlier. I don't know if say you picked on it. It was around how do you support entrepreneurs as Helios investment partners directly versus those that are innovation from some of your growth PE investments. So they gave the example of where Equitel is, or equity agency banking is a competitor to some of the fintechs that Helios may fund. I don't know if it's still there. I see it's not on my portal. But it was an interesting question, I thought, in terms of strategic partners or strategic players versus fintech innovators, and how do we create an enabling environment when you're funding both?
I think number one, we are a very entrepreneurial firm. We were set up by two entrepreneurs, and we like supporting entrepreneurs. And our two unicorns are there. They exist, and they became unicorns primarily because of the entrepreneurs that led those businesses, not because of us. Having said that, as a kind of large institutional asset manager in Africa, we obviously have a very strong portfolio operations team that provides value creation support to our businesses, whether it's human capital, whether it's raising debt or equity capital, whether it's finding commercial opportunities or acquisition targets across borders, and so on and so forth. We, as a result of being kind of a large and institutional asset manager across the continent, and having kind of that team, we can provide kind of substantive support to our entrepreneurs. Having said that, unicorns become unicorns primarily because of the entrepreneur, not because of the investors. Although the investors kind of help and facilitate and provide guardrails and capital and such, and are a kind of shoulder to cry on, but primarily they become unicorns because of the entrepreneurs. And our job as investors is to find those entrepreneurs.
Well, thanks, Said, and I hope Lewis that puts your answers your question. They support the entrepreneur, not necessarily there to do the active management. So whether it's with a strategic or directly in the FinTech, at the end of the day, it's dependent on who the founder is. I had a time till 12:30, and I think we've covered quite a broad scope of the FinTech ecosystem. At this point, I'd like to invite my panelists to give any parting shots. We can start with Juliet. You're actively in that space of FinTechs. What can we expect in 2022 from your crystal ball?
Yeah, I think from a regulatory perspective, and of course based on the area I work in, I think that the future is looking more at central banks getting more involved with innovators and being able to provide either an enabling environment or being able to try to mitigate risk as much as possible for their consumers. For the central banks, their mandate is at the end of the day to ensure financial stability, protect the consumer. And so I think some of the trends, or rather one of the trends I would speak to, is looking towards moving away from decentralized cryptocurrency or digital currencies into a stable coin or digital currencies issued by central banks. So that's something that's under research in a lot of different markets, has actually recently been launched in Nigeria, so with eNaira. So it's a new technology. It's a huge step, I think, even from a central bank or regulatory perspective. But they are looking to bring more under their scope, more under their ambit, and to have more ensure protection really of their markets, as it were. So that's it from me. Thank you.
Thank you so much, Juliet, for that. Peter?
Interestingly, I'm on the opposite side of Juliet. I think we are headed more towards decentralization and token-based economies, because this is what now most people are referring to as Web 3.0. So that's where I feel we're headed towards. And so the winners are going to be the platform creators, the people who also create, in a gold rush, you want to be the one supplying the shovels, not the one doing the digging. So I think the ones who are actually providing those trucks are the ones going to be the winners. So that's where I see financial technology headed towards.
So Jacob, as a provider of this platform, you're in the money. Maybe before I give it to Jacob, who's our host, Said, parting shot, and when can we get a flatter wave interswitch in East Africa? Told you the unicorn builder.
We're not that far away from our first unicorns in FinTech in East Africa. And it has, there are other very kind of talented investors in the space as well, and very talented entrepreneurs. So I think I'd be very surprised that if we do not have a unicorn in FinTech in East Africa by the end of next year. I'd be very surprised. Yeah, and I think just for the audience, etc., thank you so much for listening in today. And please kind of feel free to reach out to myself and some of the other panelists on LinkedIn or otherwise. I'd be happy to speak to prospective entrepreneurs and provide guidance and such, and relay some of that wisdom that we think we have.
Yeah.
Okay.
Jacob,
Yeah, thank you. Yeah, thank you, Said. My takeaway and how I see FinTech space going forward is that I've seen a lot of government initiatives, both in individual countries and as well as within Africa, creating infrastructure through which the startups and FinTechs and entrepreneurs can piggyback on or can ride on for purposes of creating more products. And I see FinTech technology systems growing over time, creating products on top of other products. And just an example of this is recently the FCTA, in conjunction with the African Exim Bank, launched the Pan-Africa payment settlement system. So that infrastructure, together with other infrastructures that African governments through the Smart Africa is trying to create to enhance socio-economic development in Africa. These are opportunities for the entrepreneurs, and I believe they can be able to ride on these infrastructures to develop more and more products. And obviously, as Said has mentioned, from the legal front, we are on standby to help not only in Africa, but through our affiliation with ABDV to help fintechs across Africa to be able to be on a good legal front for purposes of launching their product and successful finance raising in this market. Thank you, Eva.
Thank you so much, Jacob, for all the insights, to Said, Peter, Juliet, for your contribution, and the 104 audience members who've stayed on 5 minutes into the call. I truly appreciate your engagement. There's a lot more questions on the Q&A panel, but I'd like to thank again Orara and Company once again for allowing us to have this discussion that clearly can't be exhausted. And we look forward to a year of unicorns in East Africa from the known, as well as hopefully our audience who we probably have not interacted enough with your platforms. All the best, everyone. It's still early in the year to say best wishes in everything that you seek out to do. And I hand the mic back to Pamela.
Ladies and gentlemen, that was indeed a very interactive session. And I would like to thank our moderator, Eva. Thank you very much for that excellent moderation. I'd also like to thank our panelists, Juliet, thank you very much. Said, thank you very much. Asante sana.
Sure.
Yes, I'd like to thank Peter. Thank you very much. And of course, our very own Jacob. That was very informative and engaging. I'd just like to also confirm that this recording will be forwarded to all the attendees on email, and just encourage you to continue these discussions. And if you need any further clarification or you have any questions, please don't hesitate to contact us on email or LinkedIn. Our email address is legal@oraro.co.ke. I'll just repeat that, legal@oraro.co.ke. Thank you very much and good afternoon.
Good afternoon, Pamela. Bye, everyone.
Bye-bye.
Bye.